Coming up on Retiring Well.
If you understand this power of indexing, it gives you three real powerful tools or outcomes when it comes to your retirement planning.
Well, as interest rates are going down, that makes bond values go up, okay?
All right.
But the opposite holds true, okay? When interest rates rise, bond values can go down.
What of that $500,000 401k number am I willing to lose?
Right.
You know, because many years people have this menu of options they're picking from, and I don't think a lot of people understand the risk they're actually taking.
Retiring Well, helping you make smart decisions with your money so you can live a better life. Today is the day you can take back control of your money. Retiring Well, where we believe your best is yet to come.
Welcome to Retiring Well. I'm your host, Michael Reese. We are so excited to have you with us this week. We are going to talk this week about this concept called the power of indexing. Now, you might be thinking, what? Power of indexing? What the heck are you talking about there? Well, this is really important for you to get your arms around because, if you understand this power of indexing, it gives you three real powerful tools or outcomes when it comes to your retirement planning. So let's just real quickly dive into them at a high level, and then as the show goes on, we'll dig in a little deeper. First and foremost, what does the power of indexing do for you? Well, if you do it correctly, what it will allow you to do is as markets grow, you can grow right along with those markets, but more importantly, when markets go south, if you do it the right way, you can protect yourself from losing a whole bunch of money when markets go south. So in other words, capture a bunch of the upside, but try to avoid most of the downside. Indexing can do that for you if you're doing it in the right way. Secondly, well, if you've been watching the show, if you've been paying attention to the financial media, you already know that when interest rates rise, well, that's a real bad thing for bonds. In other words, bonds have a tendency to go down as interest rates rise. So if you understand the power of indexing appropriately, you can find that, wow, look at this. Here is a way to hold bond-like assets, but not have to worry about that interest rate risk that those bonds have, which means a rising interest rate environment hurts bonds. You do indexing properly, it does not. And then finally, the third thing we're going to talk about is this. When my father retired, he came to me and gave me his 401k. He said, here, Mike, I want you to do three things. Protect my principal. Give me some income. And if you can, I want you to grow it a little bit. Now think about that. Protect your principal. Take some income. And if possible, grow it a little bit. Isn't that what we all want with our portfolios during our retirement years? I thought my dad did a great job really laying that out. In any event, when we talk about the power of indexing, if you understand it and you use it appropriately, it can go a long way towards helping you accomplish those three objectives of protect principal, take income, and still grow it a little bit. All right, that sounds like it's going to be a great show. I don't want you going anywhere. We will be right back.
Are you ready to face today's retirement challenges? Are you prepared for potential market corrections and economic downturns? Are you implementing viable tax strategies to reduce your liability and protect your assets? Are you able to make informed decisions to safeguard your retirement savings and income? Centennial Wealth Advisory presents Mastering Today's Retirement Challenges. We are Northern Michigan's financial advisors, specializing in retirement planning with offices in Traverse City, Petoskey, and Gaylord, and we invite you to an informative presentation with a complimentary gourmet dinner. Learn how to use the new tax reform to your advantage, the best way to generate lifetime income, how to identify and manage financial challenges, how to maintain growth opportunities and reduce risk, and much more. Call 888-608-5825 to register and choose the date and location that works best for you. Tuesday, September 11th at Boone's Long Lake Inn in Traverse City. Thursday, September 13th at Stafford's Bayview Inn in Petoskey. Or Wednesday, September 19th at Boone's Long Lake Inn in Traverse City. Presentations start at 6 p.m. and are free to attend with a complimentary gourmet dinner to follow. But seating is limited and fills quickly. Call 888-608-5825 to reserve your seats today. There is no cost and no obligation. Don't miss this important presentation, Mastering Today's Retirement Challenges. Call 888-608-5825 today.
Welcome back. I'm sitting here with Larry Flynn, one of the lead advisors at Centennial Wealth Advisory, offices in Traverse City, Petoskey, Gaylord, all over the north. And Larry, this week we're talking about the power of indexing. I know you're very familiar with that. And why don't we start here? Why don't we start with the bond side? Okay. Interest rates and bonds and how they all correlate and how indexing helps. Why don't we start with that? What are your, help the viewers understand interest rates and bond values. What's going on there?
Okay. Well, Mike, this is something very, very important to understand. We have been in a declining interest rate market for probably 35, 40 years.
Oh, yeah.
If you go back to 1980, the 10-year Treasury was just under 16%.
Holy cow. Wait, so 10 years, you could lend the money, you could give your money to the government, and they would give you for 10 years almost 16% interest per year, and then give you your principal back at the end.
That's right.
Sounds like a sweet deal to me.
Now imagine doing income planning in that day.
Yeah, right? Easy. Easy peasy.
Very easy. Well, fast forward to 2000, the 10-year Treasury rate is now just under 7%.
Okay.
Fast forward to, I think it was a year and a half ago, okay, they hit a historic low of 1.36%.
Wait, so we went from 16 down to about 1.
That's right.
Holy cow.
That's right.
Now, what kind of impact does that have on bond values as it's happening?
Well, as interest rates are going down, that makes bond values go up, okay?
All right.
But the opposite holds true, okay? When interest rates rise, bond values can go down.
Okay, so we've seen that happening here, well, really kind of the past year, right? We've seen interest rates are starting to go up.
Right.
So have bond values then been going down?
Yes, they have.
Okay.
And here's how it works. A lot of people go, well, I don't understand the interrelationship there. How does that happen? Well, let's just say I have a bond today paying 3%, right? And tomorrow, because rates are rising, I can get a bond paying 4 or 5%, right? Mm-hmm. Who wants my bond paying 3%? Yeah,
if you tried to sell that 3% bond, people would pay less money, because for the same money, they can go buy one, give them more interest.
That's right. Because what's going to happen is, now depending on the maturity, but let's just say it's a 5-year maturity. So what's the discount going to be to that bond fund for losing 1%, 2% over the next 4 or 5 years?
Yeah, it adds up. So now how does the power of indexing help clients and investors? How does it help them in that type of environment?
Well, today in most indexing strategies, the concept is very simple. When markets are not cooperating or going down, you make nothing. Okay, that's your base. You're not going to go below where you started, okay?
All right.
But when markets are cooperating, most indexing strategies are going to tie their rate of return to the upside.
So in other words, they get some of the upside or a portion of the upside, but none of the downside.
Right.
Who does that kind of thing?
Well, typically when you're dealing with those kind of financial instruments, you're in the insurance world.
So insurance companies do that. Do banks do it as well?
Banks have their own version of these, what they call equity-linked CDs.
Okay, so you've got banks do this kind of stuff, insurance companies do this kind of stuff, and depending on how this is all structured, can they be used as an alternative to bonds?
Yes, they can.
And does it work pretty well?
Yeah, because one, they can typically get you, if markets again are cooperating, they can give you a little better yield on your investments, most traditionally to what bonds did in the past, and you have safety.
Okay, so you get to go up when times are good, but safety when times are bad.
That's right.
So that works on the bond side. Now, what about, let's say you have investors that are a little more conservative on their, they want to grow their money, but they want to be conservative. Are there other types of strategies, indexing strategies that might be helpful for them?
Well, I dare say, we think that person that just wants to be safe, right, that might be the strategy. But in all honesty, for somebody that's actually trying to grow a portfolio, it can work very well too. So if you go back to 2000, right, we watched the market drop to half its value, 2000, 2002, right, and then again in 08. Well, had I just had an account that made just a little over 4% every single year with no down, right, during that period, I probably would have been at the same point as a person taking all the risk in the market.
So what you're saying is, person A says, I'm going to be 100% in the market for my growth. And since 2000 to the end of 2017, I think the math is that about 4.5% compounded rate of return. Yeah. Someone who's earning 4 or 5% a year safely with no downside would have been at the same point, but a lot, a smoother path, a lot more comfortable path. Is that what I'm hearing?
That's right.
Okay, so indexing can help us then, Larry, if I'm correct. It can help us with bond alternatives. It can help us with maybe a more conservative way to grow our money. So it can work in a couple of different areas. Is that correct?
That's right.
Okay, fantastic. Larry, thank you. That was fantastic information. Really appreciate it. Folks, I thought that was great. I hope you did too. And I don't want you going anywhere. We've got still a lot of wonderful information for you. We'll be right back. Hi, I'm sitting here with Larry Flynn. Thanks for being here, Larry.
Thank you, Mike.
He's one of the advisors at Centennial Wealth Advisory. And folks, as you may know by now, we certainly invite you to come visit with us. It's absolutely free to get a second opinion on your retirement planning. And I think it's important to get a second opinion from someone who's a specialist when it comes to retirement planning. And Larry, I'm sure they're wondering, if they pick up the phone and they call and come visit with you, what can they expect? What's that experience like?
Well, Mike, they can expect not to get hard sold, okay? We're going to greet them warmly. We're going to sit down and talk to them a little bit about maybe their story, where they're from, where they grew up, how they met their spouse, what they're dreaming of doing once they get soon to be retired or retired.
Kind of what are their goals, right?
Yeah, what are your goals? We're going to talk to them a little bit about who we are, what we do, show them how we do things, especially dealing in the market realities we find ourselves in today.
Got it. So essentially, they're coming in, you're learning a little bit about what's important to them, what their goals are, what they're trying to accomplish. I'm sure you're taking a look at what they're doing so far. You maybe share a little bit about you, and it's just in a very relaxed atmosphere.
That's right.
And there's no cost to do this. Is that correct?
No cost. No cost.
All right. So, folks, there you go. I mean, it sounds very simple, very easy, very laid back. There's no reason for you not to just pick up the phone, call the number on the screen, come visit us, get that second opinion. You'd be glad that you did.
Do you have a plan for how to generate income during retirement? Are you going to run out of money? In today's marketplace, retirees have concerns about the volatility of the market. People have concerns that the traditional balanced portfolio strategy that advisors used in the 80s and 90s isn't good enough in today's new normal economy. There are more secure options available for you today, and that's what we specialize in here at Centennial Wealth Advisory. If you don't yet have a plan or would like a second opinion on your retirement income plan, please call us today for a free, no obligation, complete retirement review.
Welcome to this week's Chalk Talk. We are talking about the power of indexing. So here is a little example, just a hypothetical example of what markets might do. Let's pretend you start with, I don't know, $100,000. And the very first year you're up 20%. Yay, it's awesome. How much do you have? Well, you have about 120, and everything's good. But sometimes the markets, they don't go up all the time. Sometimes they go down. So let's say the next year it's a bad year. The market's down 30%. Well, Year 120 is now down to 84K. You're like, bummer, this stinks. But you hold on, because you know markets go up over time, and the next year markets are up 20% again. Well, where are you now? Well, if my math has it right, you're right around the same, about 101,000, give or take, you know, right in that range. And then next year the market's up another 20%. Well, now where are you? Well, basically, you're back at the 120K, pretty close to maybe 122 or something like that, where your high point was. But anyway, you've invested 4 years here, and hey, you're doing all right. You're making money. Now, here's where the power of indexing comes into play. And remember, what I'm about to describe, it's available. You know, banks have these options. Insurance companies have these options. If you're investing money with a bank, your money's protected with FDIC. If it's with an insurance company, you're protected by the claims paying ability of the underlying insurer. So anyway, you have different ways your money's protected. But insurance companies, banks, they have these indexing options. And the way it works is, let me give you an example of just one. Now, there are tons of these things, but let's just pick one. There's one of them out there where they'll say, tell you what, if the market is up, we'll give you half of the upside. But if the market is down, you get a 0 for the year. So let's take a look and see how this looks. First year, the market is up 20%. Now, what did I say you get? Do you get all of it? No, you only get half of it. So here, let's see, maybe you might be right here. Maybe you go from there to there. You're at 110. You're after 1 year and you're saying, oh my goodness, this is not, I was better in the market. Why would I do this? What kind of dummy am I? Well, then the next year, though, what happens? The market goes down. So what happens to your money? Well, in that year, you're just flat. You're still at 110. So you didn't make any money, but you also didn't lose any money. So in essence, you are, you know, you didn't lose, but you didn't make. You're just treading water, as it were. Well, the next year, the market's up 20% again. What do you get? Well, what did we say? You get half. You get 10% of 110,000. Well, look at this. Now you're up to 120K, or 121 roughly. And again, the next year, your market's up 20. What do you get? Half. You get 50%, 10% of 20. Well, what's 10% of 120K? Like 12,000. You're now up to, if I can get this going out well, you're up to, oh gosh, that's no fun. Use a different color here to show you where you're at. You're at 132K. Now, isn't this interesting? Let's take a look at what's going on here. Which line is smoother? Well, the green line's smoother. Which line gave you more money? The green line gave you more money. In other words, in this scenario, this particular scenario, less risk, yet you got more money. See, this is the key to the power of indexing, and here is something that Warren Buffett and Sir John Templeton and all these top investors know. They all know that avoiding losses, that is the key to financial success. Avoid losses. You don't have to have big gains, you just got to not go backwards. And is it true that every single market scenario that the green line will end up higher? No, it is not true. But it is true that over time, that there are a number of time periods where the green line does better. For example, between 2000, 2017, the green line made more money than the white line with none of the risk. In other words, the power of indexing gave you more money without the risk. Whereas In the 80s and 90s, maybe the stock market did better. The point is, they're both acceptable, but make sure you know which line you're on, and are you on that line for the right reasons. Hi, it's Michael Reese here. I have in my hands a copy of our #1 best-selling book on Amazon in its category, Retiring Well, How to Enjoy Retirement in Any Economy. In this book, we cover the 4 big areas of retirement planning: income planning, investment planning, tax planning, and estate planning or legacy planning. It has everything you need to know about your retirement plan, and I want to get you a free copy. So how do you get a free copy? It's really easy. Just call the number on the screen. Come visit with us. Come on in for a free, no obligation financial planning review. And when you come in to get your planning reviewed, we'll give you a copy, your very own copy of this best-selling book, absolutely for free. Again, just call the number on the screen. I want you to get your free copy. I know that you're going to love it.
Are you ready to face today's retirement challenges? Are you prepared for potential market corrections and economic downturns? Are you implementing viable tax strategies to reduce your liability and protect your assets? Are you able to make informed decisions to safeguard your retirement savings and income? Centennial Wealth Advisory presents Mastering Today's Retirement Challenges. We are Northern Michigan's financial advisors specializing in retirement planning with offices in Traverse City, Petoskey, and Gaylord, and we invite you to an informative presentation with a complimentary gourmet dinner. Learn how to use the new tax reform to your advantage, the best way to generate lifetime income, how to identify and manage financial challenges, how to maintain growth opportunities and reduce risk, and much more. Call 888-608-5825 to register and choose the date and location that works best for you. Tuesday, September 11th at Boone's Long Lake Inn in Traverse City. Thursday, September 13th at Stafford's Bayview Inn in Petoskey. Or Wednesday, September 19th at Boone's Long Lake Inn in Traverse City. Presentations start at 6 p.m. and are free to attend with a complimentary gourmet dinner to follow. But seating is limited and fills quickly. Call 888-608-5825 to reserve your seats today. There is no cost and no obligation. Don't miss this important presentation, Mastering Today's Retirement Challenges. Call 888-608-5825 today.
Welcome back to Retiring Well, here with John Torbett and Art Canfield, senior partners and financial advisors here with Centennial Wealth Advisory. And Larry and Mike have been talking a lot about the power of indexing. But before we jump into that, Art, I wanted to talk to you a little bit prior to getting into any of that, talking about risk and where that comes into play, especially in our scenarios where we're sitting down with a lot of times people that are closer or in retirement. And so talk to me a little bit about risk.
Yeah, what a great topic just in general. We could talk for hours on risk, because especially when somebody gets to this point in their life and how different people view risk differently. Everyone, we talk to thousands of people every year and probably don't get the same answer once when we ask, what's your comfort level? What is that? But when you look at where you were in your younger years when you're contributing to where you are in retirement, it's far different, right?
Oh yeah, the attitude changes, right? You go from this growth and accumulation phase of your life to more of a preservation and income phase when it comes to retirement. And so that's a lot of times what we're focused on, is understanding each individual or couple has their own attitude towards risk and the markets and all of that, as well as then there's a need factor involved, when a lot of times when we're putting together plans and we see, okay, if you could just make a reasonable return, you don't really need to be taking on a lot of risk in order to accomplish those goals that you've set for retirement.
Right. And especially, I think of that person that maybe has a 401k that's been working for several years. They've been enjoying some decent returns in the market of the last few years, and they're nearing retirement. And have they ever thought to themselves, what am I willing to lose?
Sure.
And, think of like a 1 year period. What in a 1 year period of my, let's just use $500,000 for ease and measure, what of that $500,000 401k number am I willing to lose?
Right.
Because many years people have this menu of options they're picking from, and I don't think a lot of people understand the risk they're actually taking.
Right. And so that's where then it comes to the conversation of, okay, let's talk about the power of indexing and these different tools that are available today for those that are in that retirement or mindset and looking ahead to say, you know what, maybe I don't want to be taking on as much risk anymore. I've been in this 401k, I've seen these ups and downs, the roller coaster ride, and I'm sort of beyond that now. So what are some of those options?
Yeah, I think people too are saying, they've gotten, interest rates have been pushed so low, and they're used to the days of the 7% CD or better seem to be behind us quite a ways. But, so I think a lot of people just don't know the options, right? And that's what this show is really trying to show is, hey, what are the options that maybe don't have to take that risk that you have in these other things.
Right.
But, you look at like what are the banks offering right now, right? Of course, standard CDs, savings, obviously, stuff like that. Some banks offer equity-linked CDs. Mm-hmm. So basically a CD, but it's tying it back to some index, and there's some rules and stuff of that that go along with that.
Yeah, but I mean, ultimately, like those are options where your principal is protected, so you're not taking on risk with that. But then so you've got the banks, government has different bonds that during different terms with that. You've got the insurance companies are basically offering different fixed annuities or fixed indexed annuities where they're ultimately saying, okay, your principal's protected, but we're either going to give you a fixed interest rate or an interest rate tied to an index in the market. But what are some of the disadvantages? Because I mean, it's nice to talk about, okay, yeah, here's a safe option, but what are some of those disadvantages that you see with those?
Right. I think of like we'll pick on the equity linked or that indexing approach ones first. There's thousands of them out there for one, so you have to sift through and find the one that's best for you. Many of them have caps. Where they say you can participate in, let's say, the S&P 500, but we're going to cap your rate at 5%, or that cap can move. Sometimes you have to watch that. The other thing that I think a lot of people see as a big disadvantage, and depending upon that person, is the term.
Sure.
You're going to have to commit your money for some period of time. If these companies are going to, these insurance companies are going to give these guarantees in place, they want to have your money for some time.
Right. So ultimately, there are some obvious disadvantages. I mean, there's a term involved. There's some limitations on what you can draw out of those accounts during that time frame. So it's something we always encourage people. Understand the disadvantages. Just as important as knowing what the positives are, you want to understand the disadvantages and make sure that you're clear on what that is before you ever go into any type of account like that. So thanks again for tuning in to Retiring Well. If you have questions specific to what we've been talking about, feel free to call the number on the screen. Thanks again.